Many investors are asking this question: should I buy the dip in the first quarter? And historical evidence says yes. Hey, I'm Luke Downey. I am over at mapsignals.com. I am recapping our latest Big Money Insights piece. It is a great one. So let's go ahead and get to it. We know that headlines rarely offer value. If you remember last year, people were talking about an economic collapse. Just didn't happen. Housing was supposed to collapse. It just didn't happen. Instead, stocks staged a magnificent rally. However, that has changed over the past week. The S&P 500 has had a pretty rough start to the year. You can look here. This is at the end of the year for the first few days. And we can see, look at this, the NASDAQ down 2.79%. The Russell 2000 small caps down 3.35% since the end of the year. You can see some of these other areas that are clearly leveraged on the smaller side. Look at this, semiconductors, one of the best performing areas of last year, down over 5% over a few days. So people are wondering, should I cut and run? Absolutely not. And let's go ahead and look at our data to get us a better understanding of where the market sits. The Big Money Index, right? Remember when it was oversold at the end of October and we're telling you to buy? Well, now we're overbought. This is the opposite type of environment of what we saw just a few months back. Now, on the previous times when we were overbought, markets soon started to head lower. That is not the case right now. So even though markets, right, the major indices are under pressure, when we look at our data, we're seeing more of a rotation under the surface where investors are dumping popular areas, maybe like technology stocks, and buying other unloved areas like healthcare, maybe financials, etc. So don't get too spooked right now. And this brings me to why you should buy the dip in the first quarter. Let's look back at some recent history. So since 1980, the S&P 500 has an impressive gain of 2.07% in Q1. Now get this, Q2 to Q4, that's April through December, it's about 8% returns. And again, you've heard people say, oh, stocks, they average 10% a year. That is absolutely correct. So this is what you can expect in a normal year. This is 44 years of data. But there's something very interesting about 2024. It is an election year. And check out this study. Believe it or not, in Q1, we tend to get a lot of volatility. You can see that in 1980, 84, 92. We all remember 2008. And of course, the COVID pandemic. Stocks were down 20% in Q1. But listen, that's where the bad news ends and the juice begins, because starting in April, Q2 to Q4, a lot of green, and you're looking at an average 8.06 return for the rest of the year. Here's the returns for the S&P 500 in election years. It's not that great. It's 5.81%, right? That's well below that 10% average. However, keep in mind, we had some pretty ugly years. These one-off tech bubble down 10%, the great financial crisis down 38%. That is not the scenario that we are staring at in 2024. So when I see red, this is normal action that we've seen in prior election years. And I think you're going to want to buy the dip. Talk to you later.